Hello, you're watching Smart Money, and today we're talking accessing equity markets through online investing. Tinus Rautenbach is the business head of Clarity by Investec. He's been instrumental in shaping the bank's equities offering with a focus on improving trader performance through structured practice and behavioral finance. And he joins us now. Tinus, good to have you with us. Thanks so much for your time. And I'm going to launch straight into it, right? Because Clarity by Investec launched in February this year, roughly 6 months in now. What growth has the platform seen?
Hi, Alicia. Thanks for having me. Just a small correction. We actually launched to Investec clients about 18 months ago, and then we launched to the wider, non-Investec base in February, and we've seen really good growth from our Investec core Investec clients, but also now from people joining us. That's not not traditionally Investec clients, and we're very excited about the type of activity that we see and the type of ideas and how clients express their investment and then investment thesis, and we can see it in how they access the market and the type of investments that they go into. So we've seen really good growth, and we're on track.
Give us some insight, into that. What in particular stands out when it comes to the kind of interaction you're seeing with clients?
So I mean, we see quite a big percentage of our clients move value from rands into dollars. So quite a big percentage of our clients, more than 50%, actually take value into non-rand, and so we can see that offshore investing as a general idea is definitely something that our clients are interested in. So we see going from rands to dollars, and then when you go in the offshore bucket specifically, we have clients that go really just into your ETFs and into your trackers. And I'm going to go the S&P 500 as an example, Euro stocks, MSCI. We see all of that. We also see people go into the IBIT ETF, which is the Bitcoin specific tracking ETF. But again, that's a theme that someone wants to invest in. And then we do see quite a bit of speculative access as well, where clients want to have exposure to Nvidia on the day. And we see both of those. For our local clients, we are a local platform. Our investors and our clients know the local brands, and as part of that, some of the traditional South African favorites, both from retailers through to oils like Sasol, etc., miners, Anglo Gold, Anglo's, Simbanya, all of those are popular names on the platform.
So that's the kind of investor appetite you're catering to, right? What do you say differentiates Clarity from other offerings in the South African online investment space at the moment?
So we believe we do a couple of things really well. We make it easy for you to deposit value onto the platform. We then make it super easy and quick for you to move that value from rands to dollars effectively within a couple of seconds. And within that same time frame, you can then go and express your international investment thesis. So you can go from depositing value onto the platform all the way through to buying Uber shares, Apple shares, Nvidia shares, within a couple of seconds, actually. And so we believe we do that really well. We make that exposure really easy. We also provide clients that really understand trading, the ability to trade and invest in with through margin trading, which is also something that is unique compared to some of the other platforms in South Africa. So both are ease of access, local to foreign, as well as then potentially some of the margin trading. And we're part of a well-established brand, part of the Investec group, and that definitely differentiates us in the market.
Yeah. And as you've highlighted, right, what this does is open up access, retail investor education in that context, perhaps more critical than ever before, Tinus. I mean, what's your take on, the gaps that need to be filled on that front and building retail investor acumen to the level needed if this market is going to be able to fully leverage the opportunity that this enhanced access brings with it?
Yeah, I mean, Alicia, we quite passionate about it. We believe in the need for more education. We believe in the requirement for where we enable clients to do it themselves, i.e. do it yourself investment or self-directed. Clients really need to understand both the rewards but also the risks in the process. If we think about it all the way on the more risky side, you can think of how clients engage with the betting sort of sites and other betting type access, and that, on the one side is really risky. And as you bring it back, we want to enable clients with the education and the information that we provide around the market for clients to understand where they've got opportunities, how they can access those opportunities, but also at the same time have enough understanding around how do I manage my risks and how do I manage my total portfolio, my diversification across my portfolio, not only through single equity exposures, but also through ETFs, for instance, where you get diversification through the product, and how you can use all these tools to effectively run good money management principles on your investments and your trading account. So education and understanding the behavior around money management and how you invest is part of what's so critical for the market.
I want to home in on diversification there because, while the session giving us hardly enough time, Tinus, to get into the nitty gritty of it all, perhaps, it does give us the opportunity to deal with the basics, a 101 lesson of sorts, right? So where investing isn't about finding a good buy and putting all of your eggs in that one basket waiting for them to hatch, why is it important to diversify across multiple asset classes as you've just highlighted?
So, Risha, it's important to understand that diversification is a way to manage your risk because you are effectively getting exposure to multiple assets in multiple industries. And the principle behind it is the old saying is don't put all your eggs in one basket. And so through the years, there's been examples where if you pick just one stock, you could have got very lucky and made a really good return, or really unlucky and the value of that share is halved or gone to zero. In the worst case. And within that context, if you've picked the wrong share, you could have had a fairly wide different differing outcomes. If you use diversification as a principle, both from an equity and a sector point of view, different equities within a sector, different sectors, and then also because of our international exposure, that you can also have foreign exposure, not only America, but the UK and Europe, you can really get a diverse exposure to a very wide variety of equities and countries and different growth areas. Now, why is that important? It's important to be able to, yes, one, risk adjust, but also it gives you exposure to certain sectors and indices through diversification that you won't necessarily have in our core market. And I will just use an example. It is almost impossible for you to get exposure to quantum computing type investment opportunities in the South African market, but you can invest in a quantum specific ETF that gives you exposure to a diversified range of stocks that specifically gives you exposure to the quantum computing thematic investment. And so Alicia, it's a long way of saying is you with diversifying both local and foreign, and then looking at sectors that could be interesting that we don't have necessarily exposure to here, but through this diversification, you can get a wider exposure to interesting investment ideas, but also minimize your risk because you are not going, putting all your eggs in one basket.
If I had to ask you this question, quick wins, even if it comes with a lot of risk, versus a long-term approach to investing, Tinus, which is the right or the better approach? And if there isn't a direct answer to that question, which is more suited to what kind of investor?
Yeah, I think I want to say there are different investment styles and different personalities that will engage with saving and investing in a different way. And so let's start on the one side. Why do we believe it is prudent to start investing in the equity market for the long run, so not speculatively, for the long run? Is because we believe that equity markets over the long run will give you a risk-adjusted return that is above inflation. And, it should be, call it 5% above inflation over a very long period of time. And so it's important for you to start investing and start putting money away linked to the equity market, because we believe the equity market over a long period of time will give you inflation beating returns. Yes, you can't pick it necessarily for the next 6 months, but over a long period of time, that would be the case. On the other side of the scale, we do have a number of clients on our platform that are definitely much more around timing the market than time in the market. So they're trying to time the market. They're looking for investment ideas that are much shorter dated, sometimes minutes, hours, days, because they believe there is a certain reason for an asset to reprice. And that could be market information coming, that could be results, it could be news flow. There are many different reasons why assets will reprice in the short term. And there are clients that would take that as an input and opportunity to access the market at that time. That is different to, as I said earlier, having a long-term investment philosophy. And we believe that for most people, long-term investing, getting exposure to the equity market will give you that long-term outperformance that is, above inflation. But for someone that has got the time to first study the market, understand the risk and the money management around it, also looking for shorter term opportunities is definitely a pursuit. And we have many clients that does that and are successful at executing in that way.
Tinus, as we wrap this conversation up, there's still a perception that investing and wealth building are the domain of the wealthy, right? How do we break that perception and get that narrative to shift towards, anyone can build wealth over time?
See, Alicia, I think what's happened over the years is information used to be distributed asymmetrically. And so, certain investment information was only distributed via companies to a small investor base, and that information did not distribute wider. But we live in the 21st century now. We have got access to the world's information on your smartphone. And so the access to the information and to investment ideas and opportunities has been democratized, and everyone's got access to it. So now anyone can, if they apply themselves, learn about it, self-educate, and there's no barrier to that information because that information is available. The second thing is then once I know and I've learned and I can choose to invest in something or transact or trade in something, the second part is then, okay, now how do I do that? Now, traditionally it was, harder to access a stockbroking account or some other banking product, etc. But again, the platforms, and like Clarity, we've made it really simple for someone to open an account, and then there are no monthly minimums. There are no minimum amount that needs to be started with. And if you want to, you can buy a portion of an ETF or a portion of a stock, which means you can really start with a small amount and build your way up and get exposure to the market and learn about the market. So I want to say it's two things. The one is access to information. It's now available. And the second thing is, once you want to access the market, the platforms make it really simple to do it now.
Well, Tinus, thanks so much for having joined us on Smart Money today. Tinus Rautenbach is Business Head of Clarity by Investec.